Good morning and welcome this morning to Trading a Smaller Account. My name is Ben Watson. I'm an education coach and a senior manager here at Charles Schwab, and I'm sitting in for Barb Armstrong today. I am not Barb Armstrong, and I don't even play her on TV. But hey, we're going to talk a little bit about some of the things that, some of the instruments that can be used in a smaller account that may be beneficial in certain circumstances. So we're going to jump in here really quickly on that. But I've got my good friend Michael Fairborn out there in the chat helping out with me today. He's going to be there to help answer your questions in this discussion, whether you're here live. And if you are here live, make sure you chat your questions in. If you're here in the recorded version, make sure that you leave us some comments in the description and in the comments section of the webcast. And that's going to help us to not only make this session better for you, it's going to make it more interactive for you as well, and help you to get some of your questions answered. Speaking of some of those questions, one of the things that we do, we talk a little bit about some of the things that we ought to be concerned about, some of those housekeeping items that we need to make sure that we're aware of. Remember that everything that we talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular strategy or account type or method or approach or anything else. Also, remember that options, including index options, which we may talk about today, carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, one of the things to remember is that options do carry with them an element of risk. Some options, American style options, can be assigned early. So if you're short that option, you could end up taking that early assignment. Index options, which generally, we'll talk about this today, are European style options. Those options cannot be assigned early. They cannot be exercised early, which means that if you're short that option, you can't see early assignment. We'll talk about that in this discussion as well. Also, remember, we're going to be using the thinkorswim desktop software platform, specifically the paper money version of that platform today. That paper money platform is a great learning environment. It's a great sandbox to play in. It is not, however, a guarantee of future success. And one thing to pay attention to, especially as you move up from a smaller account to maybe growing your account, you move up from practicing in paper money to live trading, remember that there are some differences between the paper money platform and the live trading platform. Specifically, one of those being that the paper money platform does not facilitate the early assignment of short American style options. So be aware of that as you make that transition. Also, remember that investing involves risk, including the loss of principal. When we talk about rolling strategies can entail additional transaction costs. They are not a magic wand. We'll talk about that as we get into this discussion. And of course, past performance, not a guarantee of future results. So let's do this. Let's talk a little bit about where we are going here in the context of this class. And I'm helping out Barb today as she is out on, I believe, vacation today. I'm going to be out the rest of this week doing live events, both a branch event in the Tampa, Sarasota area, as well as our advanced options workshop in Dallas, Texas, coming up this weekend. So if you're in those areas, come and join me. But helping out Barb, I've helped out in this particular class a couple of times. And so I just want to kind of reinforce for those of you who might be brand new, as Sadie says as well, brand new, the concept behind this class of trading a smaller account is following these particular guardrails, right? The idea being that we've got a $20,000 paper money account. That's the total net liquidity in that particular account. So our maximum position size, meaning maximum investment in any one particular trade, is going to be $5,000. Maximum trade risk then somewhere between $400 to $500. So the focus in this context is short to intermediate time frame. One of the benefits of, or maybe one of the advantages, I'm going to argue that it's maybe an advantage in this particular case, of being a trader of a smaller account or a smaller portion of a larger account, that would work too, is that it might require, from a psychological standpoint, for traders to be more nimble in their approach, meaning quicker in, quicker out, and less focus on longer term trades or longer term trends, longer term perspectives. Now, that might be part of the longer term, kind of the larger portfolio, and this smaller chunk might be the more actively traded chunk as well. And that's, again, another approach, right? From that standpoint. So we're going to look at the possibility of how we might use some tools to facilitate being more nimble when we're trading smaller accounts. So let's do this. Let's jump over to the Thinkorswim platform and let's take a look at what's going on in the market today. I'm going to pop over here really quickly to my index grid. Some of you have seen this before. And we're going to take a look at what's going on here. First of all, in the S&P 500, kind of the broad market index. And we can see a couple of things going on. One, a little bit of a gap down and a bit of a sell-off today to the tune of down about 2.86% on the S&P 500. Some downward pressure, some downward momentum. We can see that on the RSI. The potential here is touching down, maybe finding a bit of a support level somewhere around that 5,000 mark. I mean, that certainly would be the hope for bulls in this particular case, would be that there is some area of support. The other thing to think about, though, is, and this is always a good idea to think about, is when you're drawing lines of support and resistance, look left to confirm right. So I'm going to look over to my left here. I'm going to draw this line of support, and I'm going to go back to the August low. And we're kind of retesting that August low. We're retesting that, that high of a year ago. So there is that potential for that move to see a bit of a bounce right about where it is, right? And so what we'll do is we'll kind of focus, again, on the shorter term as we look for some of those opportunities to see if we're seeing momentum shifting in a different direction, right? Because right now we've got the RSI moving to the downside. So looking left to confirm what we're seeing right gives us an area of potential support where the market is right now. And then that previous level of support that we can see down here right around that 5,000 mark. We're currently sitting at 51.33, so it's not that far to the downside to go. Taking a look at the NASDAQ, kind of seeing the same thing. On the other hand, on the NASDAQ, kind of breaking through some of those previous lows, right? 50-period moving average, 200-period moving average, both rolling over, both giving us kind of that downward perspective. The death cross, if you want to be morbid about it, has happened, but typically that tends to be a later signal. It typically tends to be a very slow signal. And oftentimes, by the time you get a death cross, that's the 50 crossing from above to below, that the circumstance that created that has already happened and the market has already recovered. I don't know if that's the case now. But we're kind of in the middle of this range here. We've got a level of support down here around the 16,520 mark on the SPX. But if we go left to confirm what we're seeing right, we've already broken below this previous level of support, right? Okay. Now let's take a look at the Russell 2000, which is the small cap perspective. These are small cap stocks. It's a fairly broad index. Also has some sensitivity to some of the Mag 7 and some of the technology stocks from a sector perspective. And it's not quite down as much today, down 2.36 for the moment, but we don't quite have the same context. If we go left, we've got to go out to a further period of time. And so you can kind of see that death cross occurred quite some time ago, about a month ago, and now we're starting to see maybe that possibility. So the question is this a possible bounce? Do we see this as maybe a bull flag? And that initial move higher if we get some upward movement, or is this a continuation? We didn't have the gap down. We didn't have that continuation move. Now, in terms of the reasons why, well, okay, fine. It's now the first Monday back after a holiday shortened week last week. Geopolitically, there's a lot of stuff going on. We're seeing back and forth on some of the tariff issues still. We're seeing back and forth on some of the issues regarding trade deals with individual countries. And we're also seeing increasing rhetoric on the part of the administration regarding the Federal Reserve. All of those are adding to the noise, but that noise is present. We can see that that noise has been specifically present. One of the things, however, and Carol asks a great question, the VIX is up almost 17% today. All right, we can see this turnaround in the VIX, this rise back up into this kind of 34 handle, kind of mid 34 handle, right? So that being the case, that kind of additional noise and uncertainty is adding to perhaps some of the confusion, right? Now, as far as what the specific catalyst is, well, here's the other thing to think about. And maybe this is something that we might take a look at here. I'm going to go to the calendar. I'm going to go to the Market Watch tab, and I'm going to go to the calendar for this week. And we'll just bring up this week's calendar. And all I'm looking at on this week's calendar are earnings announcements. And you can see the number of earnings announcements. There's over 120, actually 170 stocks that are announcing earnings today. This is really now starting into the bulk. We've got 220, 300 plus tomorrow, 400 plus, almost 500 plus on Wednesday. You've got 400 and 500 plus companies announcing on Thursday, and then it tapers off. Not as many typically tend to announce on Friday, but you get this big bulk of companies that are announcing earnings. And that is really going to be the start of kind of the read on the impacts of tariffs and everything else, all this geopolitical noise on corporate earnings. You've got the three-pronged impact from earnings announcements. You've got, PE, you've got, I don't know, that's a good question, Carol. You've got PE, you've got, EPS, you've got revenue, and you've got guidance. And I think that's where the question becomes kind of the salient question here is, how is this going to impact? How is this impacting some of the individual stocks, number one, and number two, how is it kind of shaping the perspective on the market, right? So I'm going to kind of look down through this list from today, and we're going to kind of see what from, let's come back here. Let's go to this particular week in April. Whoops. Let's take a look at this on a weekly basis. So let's go kind of right there. So here we are, Monday. Where are we? Right there, Monday the 21st. There we go. So let's kind of scroll down here and let's see before market open, let's see what we had. If we had any that were significant that we could pay attention to and to maybe take a look at. So let's take a look at something like BOH, Bank of Hawaii, because we're starting, typically you'll tend to see kind of those regional banks. Let's come back over here to our single grid. We'll bring up our single grid chart here. And we'll take a look at BOH. Now, BOH, not a market mover necessarily, but it might give us a little bit of a read on some of the regional banks and the financials, which typically tend to kind of dominate the lead positions in earnings announcements. So we get this little bit of a gap up and a sell-off. If we come down here and we take a look, their earnings were better than estimated. Revenue better than estimated, but what I don't know is what the guidance was. So what we can do is we can come over here to the left-hand side, and we can change one of these gadgets. Let's just go switch gadget to live news, and I'm going to put in that symbol, BOH. And the reason I'm choosing this is just because they were kind of first out of the gate here this morning with earnings announcements, right? So let's take a look. Let's go to one of these news stories here, and let's say, all right, Bank of Hawaii posts a first quarter profit climb, increase in profit in the last quarter, provision for credit losses declined. So let's see what their forward guidance, all right? All right. So forward guidance seems okay. We get a bit of a gap up and a little bit of a sell-off here. And again, that's kind of that relational understanding, right? And Carol says, yeah, guidance in a lot of cases is being withheld, right? And so we're starting to see this move, this little bit of a gap up and a sell-off. Now, I know we've got a couple of others that are coming with earnings. Delta Airlines has already come with earnings so far this season, kind of late in the previous season and early in the next season. Their revenue was good, guidance was good, but EPS was good, but guidance was bad. We've also got Tesla coming with an earnings announcement, and that's probably going to be the next. That's coming tomorrow afternoon. That's likely to be kind of the next big market mover because it does garner a lot of attention from the standpoint of its position in that Mag 7 and its position kind of politically and in the milieu of what's going on. The other thing we've got is NFLX, Netflix. And Netflix coming out of the gate with earnings last week with a big beat, big move in terms of guidance, and this move to the upside. So you've got things kind of on both sides of the equation here, both pushing the market up and pushing the market down. So what do we do, right? I mean, this becomes a challenging situation where individual stocks are seeing some volatility. There is upward movement in some stocks. There is downward movement in other stocks. So as a trader of a small account, one of the temptations is, because in trading a smaller account, a stock like Netflix, which is moving up and moving a little bit higher, becomes a little bit further out of reach, right? With the exception of potentially trading some option spreads. But that again presents systemic risk to things like earnings announcements. So how do you trade the whole market, right? How do you kind of trade somewhat of a not necessarily balanced perspective, but a smoothed perspective on the market, if that makes sense? How do we trade kind of X those individual earnings risks? And one of the ways to do that may very well be simply trading the index itself. Now, we're going to do this using options. And I'll show you this and show you what I mean here. I'm going to bring up here in my single grid, I'm just going to bring up SPX, right? This is the S&P 500 index. And this is simply an accounting of the market-weighted values of the components of the S&P 500, as is the NDX, the NASDAQ, that accounting for the values of those components, as is the Russell, right? I mean, this particular index is the same thing. So what do? Right? That, if we go back to the SPX, we can't trade the index itself, meaning we can't buy shares of the index. Now, we could use an ETF, we could use a futures contract. Those are all separate instruments. We're not talking about those. And let me just say this. If you're going to trade futures, make sure you're aware of the risks of trading futures. It's a highly leveraged product. It requires separate trading authorization. If you're going to trade ETFs, make sure that you're aware of the risks and characteristics of trading ETFs. Make sure that you understand the characteristics, risks, charges, and expenses of any product that you are trading, just so that you're aware. We're not going to talk about those, right? So that being the case, how do we take advantage of the circumstance that exists? How do we take advantage of, say, for instance, this potential downward movement in the SPX? Well, we could come over here to the trade tab, and you notice that in this particular index, let me go to the SPX here, SPX. In this particular index, because this is a cash-settled index, it behaves and looks a little bit different than a traditional option. Remember, I also mentioned at the very beginning that index options, especially European-style index options, don't allow for exercise of options prior to expiration. Now, that could be a potential challenge to us if we are the buyer of an option, but if we're the seller of an option and we run that risk of being assigned, that could be a benefit. And for a trader of a small account, that could definitely be a benefit. And again, remember, I'm not advocating any one particular type of activity or any particular instrument. These are simply illustrative and educational examples. But since we can't buy, if we go up here and I click on the ask price, SPX is not a tradable instrument. It's just that accounting of value. But what I can trade is an option on that index. By the way, I happen to teach on, let me show you this, on Wednesdays. Let me go to the live webcast calendar. On Wednesdays, I teach a webcast called Trading Index Options. So I'm borrowing some of the things from that particular webcast to talk about in this particular discussion. And I'd love to have you join me over there for that one as well. It is at 11 a.m. Eastern time. So smaller account in this particular case, Anoop, means $20,000 or less. Okay, so that's where you can find more information about trading index options. But what we're going to do is we're going to look at trading, since we already looked at the chart here and we said, look, the SPX is moving in a downward direction. Let's take advantage of that downward direction and maybe buy a put option, right? To directionally take advantage of that downward movement. So we're going to go to the trade tab for the SPX and we're going to say, all right, I'm going to do what I would normally do as the buyer of a long option. And I'm going to go out, say, 30 to 50 days out to go until expiration. I'm going to buy a long option and I'm going to track that downward movement, and it's going to appreciate theoretically if the index goes down, right? So I can go out here, say, for instance, to the 6th June expiration, and I might come down here and say, my typical process might be to buy a slightly in the money option. Well, now this presents a challenge, right? Now this presents a challenge because if I come down here, the index right now is trading at 51.32. I come back down here and I say, look, here's a 51.40 or a 51.50. Great album, by the way. 51.60, 51.70. If I buy one of those deeper in the money options, put options to have some intrinsic value, and seeing that movement to the downside, well, if I click on that ask price, I notice that these contracts are trading for $216 per share times 100 shares. If I click on confirm and send, holy cow, the cost of this trade just to buy one put option, just to buy one directional put option, the cost of that trade is more than the entire value of my hypothetical small account, right? So I can't do that. That presents a problem. Let me just answer this question here real quickly. There we go. Okay. All right. So I can't do anything with this within that small account because the cost of trading this is pretty significant. Well, I could say, well, you know what? I could create a spread. And let's just kind of delete that. I could create a spread trade here. And let's see if I could create a kind of a long vertical spread, kind of that long put directional spread. So that would be buying that option kind of maybe in the money here. So we're going to buy that one. Let's create a long vertical spread here. And we think that it's going to go down. And so we might sell the 51.20. Well, now I still have a debit here, $12.45. I click on confirm and send. That still, even by creating a long vertical spread here, is outside my parameters for my trade, right? Because here's my parameter, right? Maximum position size, $5,000, maximum per trade risk. The amount that I'm willing to lose is $400 to $500, okay? So if that's the case, I can't do this trade, even if I create a spread on this trade. The other thing is, if we flip this around, let's come back over here and let's say, fine, delete. I'm going to create this as a call spread. Well, let's say we go out, even out to, say, for instance, and I'm going to have to add some strikes here, out to, say, for instance, 60 strikes. I go out here, say, for instance, to the 35 call, 53.70, and I say, fine, I'm going to sell the 53.70, and I'm going to buy the 53.80, or even the 53.75. We'll make it 5 wide. I'm going to bring in $2.90 of credit. Now I'm a little bit better, but I'm still pretty close. I mean, that's still, if we look at this, and I look at where that is in terms of the probability of this being hit, there's a long time to go, and I'm not bringing in that much credit here, right? So creating a short vertical spread on the index in this particular case doesn't necessarily make a lot of sense for the length of time that we might be in the trade, just because of that possibility of directional movement. If we go out to that option, which we said was about 46 days to go until expiration, we go across here, that current level of implied volatility means that the translation to potential movement for this index could be up or down about 500 points, right? So we're well within the range of that vertical spread ending up either out of the money or in the money. In the money, we don't want to have that happen, right? We don't want to take that maximum loss on the trade. Out of the money, we would get to keep the premium, but we're not keeping that much premium. So here's the benefit, potentially, for trading smaller accounts of using something like an index option, which takes away early assignment risk, okay? What that means is we can trade a shorter period of time to expiration, be more nimble, and use that to our advantage, because we don't have to worry about that possibility of early assignment of our short legs. Okay, early assignment of the short legs. So let's do this. Let's come back up the option chain here, and let's come down to kind of a narrower time frame. I want to come down to a narrower time frame. I want to even go down to, say, for instance, 1 week from now, 28 April expiration, where the current same level of implied volatility would suggest, simply as a function of time, that we only have about $194 potential up or down move. That's, less than half of that $500 potential move that we saw 30 days out or 36 days out to go until expiration. So it condenses the range in which we're likely to see the index move. Now, granted, news happens and it can change this whole perspective. But let's come over to that expiration. This is the 28 April expiration. And one of the things I'm going to show you here really quickly, and I know Barb has talked a little bit about this in this context, is the level of liquidity that exists in some of these contracts, right? So here we are. I've opened up volume and open interest on this contract. And the thing about it is, you can see that there's a lot of activity over on the put side. There is still a relatively large amount of activity over here on the call side. And we're going to create a short vertical spread here that maybe is a little bit less impactful in terms of that maximum theoretical loss. And you've got some areas where you have a fair amount of liquidity, a fair amount of volume today, and a fair amount of liquidity. Because if we're trading a large account, if we're trading a small account, we're typically trading 1 or 2 contract lots, not lots of 10 contracts, not lots of 20 contracts. So we can be a smaller fish in a smaller pond without being the big fish in the small pond, if that makes sense. So we could come out to, say, for instance, this 5,200 strike, right? And let's kind of look at where that is on the chart and say, here's 5,200. That's within the range, actually, of today's candle. That's kind of right there, right? 5,200. We're going to expect some continuing downward movement. But let's go out to that trade tab again. The 5,200 strike has some pretty decent liquidity to it, some pretty decent open interest. If we scroll down here even a little bit more, we can see that there are some areas, the 5,270, we could probably see similar types of liquidity here. So let's go out to that 5,270. We'll confirm where that is on the chart. 5270 is actually going to be up here. And I'm a little more comfortable selling this vertical spread up here at about 5270 than I am down here at 5200. So I'm going to remove my line there, and I'm going to sell at or above this level of support. In this particular case was resistance here and here, and now it was support here, and it broke that support. Now it potentially could be new resistance. So I'm going to sell somewhere up here, and I'm going to go to that 5270 strike. And you can see the narrow width of the bid-ask spread, right? I mean, that's really not terribly wide here. And I'm going to go to the five wide. So the 5275, we're going to buy that 5275, okay? And we're going to bring in $1.45 credit. And you remember we did that trade where we were looking at that trade that was 5 wide, that was about 45 days to go until expiration, and we were actually getting a little bit less net credit for that trade. Now we go to confirm and send. Now we've got $3.50 or $350, but we are only taking that risk for a period of 7 days. Now, we don't have to hold it all the way till expiration, but we're able to be more nimble in this trade. And the idea being that if the market continues to move to the downside, and it does it quickly, then this trade benefits, and we don't have that kind of lengthy time span to stay in that trade, to expect to reap the majority of the time decay, number one, that might benefit us from selling this short vertical spread. So I'm going to do this. I'm going to create this, and I'm going to send this off to my long verticals and diagonals. We're going to read through this order. So my expectation is that the index itself, remember, this cannot be assigned early, so we don't have to worry about early assignment, is going to bring in $1.50, and my risk is $3.50. If we go back and we just confirm that against our chart here, that falls below our maximum trade risk in the trade. That falls below our maximum trade risk, right? And we're going to go down and we're going to say, all right, fine, we're going to sell this vertical spread. And because of that liquidity, it's likely that we're going to find a little bit easier time getting this trade put on. And we got it for $1.60 simply because there is a fair amount of liquidity at those particular strikes, okay? So now I want to show you one other potential here, right? And Villager, I'll come back to your question in just a moment. But not only could we use SPX, which is the big cash settled index. Now, here's the thing: if we did happen to be assigned, or if in fact at expiration we held this and it was in the money, that vertical spread was in the money, that vertical spread settles to cash, meaning it's cash out of our account to the tune of whatever our theoretical maximum loss was, which was $350. Cash out of our account, not shares. Doesn't get converted into shares because there are no shares to the index. This is cash settled, and so it's a cash settled. That's why we call it a cash settled instrument. So the option itself settles to cash if it's held through expiration, if it goes to assignment or exercise. So this is the big index, right? 5140. This is the one that we always report on, you hear in the news. But there's also a smaller index. And somebody had asked the question out there in the comments section and posted a comment about trading some of these micro or mini indexes. And so David's one step ahead of me, as he usually is, which is XSP, which is the smaller, the mini index options. You notice that movement-wise, it is exactly the same. It's just a smaller notional value to this particular contract, meaning it's a tenth of the value of the large index. So David asked the question, is XSP a good choice for the small account? Well, let's look. Same things, right? We've got 527, which was that level of support right here. So let's just kind of replicate this trade. Let's just replicate this trade right here. Let's go to the trade tab. And we'll take a look at XSP. There's XSP. Now, one of the things you notice is these indexes, because of demand for these indexes and using them as hedging products by institutions, That's why we see lots of different expirations, right? So that's why we have daily expirations and a lot of choices. Now, you're right, Pablo. XSP is not as liquid as SPX, but it is becoming far more liquid in the last 6 months, in the last year, than it was before. So let's take a look at that difference in liquidity and see if that makes sense. So let's go out to the same expiration. Let's go out to that 28 days to go until expiration, 33%, $19 potential move as opposed to $190 move, but it's 10th, so we get that. So we open up the 28 days to go until expiration. We've got 60 strikes, 30 up, 30 down. And let's come back down to our range here, and you're starting to see more liquidity. So we go out to the 327, or excuse me, the 527, and right around there, we've got open interest of, 60 or 70 contracts, 10 contracts, 62 contracts, 70 contracts. So, the key here ultimately isn't necessarily specifically what this open interest number is. It is the width of this bid-ask spread, which gives you an idea of the overall liquidity and slippage in placing that trade. So let's create the trade that we did before. Let's go to the 527, and we're going to sell the 527, right? And we're going to go to the 530, right? Is that what we did? We did the 527, 530? What did we do on that last one? Let's go back over here on our monitor tab, and let's see what we did. We put it here in the long verticals. We did the 5270, 5275. So let's go back to our trade tab, and let's kind of come up with an equivalent, right? So 5270 and 5300. Let's do that. 5270, 5300. Let's do a similar spread. 86-cent credit, so almost the same amount of credit. And yes, Pavo, XSP is European style. All right. Or we could do one strike wide. Let's do that. Let's do that. Let's go one strike wide. I like that idea, David. Because we did one strike on the other one, right? So let's do that. Let's do 527 and 528. One strike wide, 30-cent credit, so about the same on a percentage basis, right? Click on confirm and send. Now our potential maximum theoretical loss in this particular case is $69 per contract. Now here's the thing. This gives us some flexibility. And the reason why I say that this gives us some flexibility is if we go down here and we edit, now what we can do is we can adjust the number of contracts, right? If we go and adjust the number of contracts, let's go to 3 contracts, let's go to confirm and send. Now we're getting just about the same amount of premium. Maybe we go to 4 contracts, should have 5 contracts. But now we're getting about the same amount of premium with about the same amount of risk out of 3 or 4 contracts that we were getting out of 1 contract before. Well, the challenge for trading a smaller account is that 1 contract, you're done, right? If you have to close that contract down, 1 contract, the trade's done. Here, if we were to put this particular trade on, and let's go put this in our long verticals and diagonals section again, just so that we can keep track of it. We click on send and we fire that order off. And that order fills for us. We'll see if we can get that. We might have to bump that a little bit. And again, this is where working that order becomes, maybe we go here to our working order section. Let's right click, cancel and replace that. Let's open up that lock a little bit and let's see if we can work that down. We'll see if we can get it for 28 or less. We'll put it back in our long verticals and diagonals. We'll click on send. We'll fire that order off. We'll see if we can work that a little bit. And again, this is paper money, all right? So the thing about it is, Jerry, open interest is relatively low here on that 529. We might move this around a little bit, or we might look for a different expiration at similar strikes to see if there is better open interest. Again, ultimately what it means is tighter bid-ask spreads, right? and a more liquid market. So that's where we kind of have to work around this. But the point being here, we've got a relative to the size of the account, relative to that size, we're still a small fish in a big pond here, or smaller fish in a big pond. Now that order filled for us, we got 30 cents per contract for it. So we got 90 cents because we sold 3 contracts. Now what this gives us is the flexibility, and this is important as the trader of a smaller account. This gives us some flexibility because what we can do is, if things start to change, right? If things start to change, we can come in here and we can close one contract. We don't have to close all 3. We can close down one contract and pare down our position size. So, trading the index options, here are the advantages that trading the index options give us. 1, it's cash settled. So you reduce some of the complexity in terms of creating long or short stock positions. 2, these that we have talked about are European style, which means that they cannot be exercised prior to expiration. So it takes out the potential risk of early assignment. Long vertical spread, that kind of is a detriment, right? Because early assignment on a long vertical spread puts you at theoretical maximum gain. But early assignment on a short vertical spread puts you in theoretical maximum loss. You can still take theoretical maximum loss for sure, but you don't run the risk of being assigned early in a short option on a European style index, putting you into theoretical maximum loss in the case of, say, for instance, what we've been doing, short vertical spreads. Number 3, the benefit is you've got choices in terms of the instrument you use. You can use the larger index or some of these minis. Number 4, you can use the fact that you don't have that early assignment risk to trade closer to expiration than you might otherwise do, so that you can accelerate theta decay, and 2, allow yourself to be more nimble. And in trading the minis, add more positions or add more contracts so that you can be more nimble in your position. You are not just stuck with one contract in a particular scenario. So that's kind of the thought process behind using index options in a smaller account. They definitely provide some benefits. I'm not recommending. I'm simply providing that as an example, right? So we didn't do put or call. We did calls. We did calls on our 2 short verticals. We did a long put vertical as our first possibility on the index, and then we did not fill that order. So let's do this. I want to pop back over here really quickly to the Schwab coaching page, schwab.com/coaching. Again, you can come over to this webcast that I teach on Wednesday mornings. I won't be teaching on this Wednesday because I will be in Tampa and Sarasota doing a live branch event. But that Trading Index Options webcast, we talk about using index options in a variety of different strategies, including for the purpose of managing risk and maximum loss for smaller accounts. So you can join us there. By the way, also, if you want to learn more about trading index options, jump in here, type in index, and you're going to get a bunch of webcasts right here in the webcast page. Also, make sure that you click on that subscribe button down at the bottom of the page. That is going to be your best way to stay connected, if you haven't done so already, to the Trader Talks webcast channel. You can follow me on X. You can follow Mike on X. I'm at Ben Watson, CS. Mike is at Mike Fairborn, CS. Barb is at Barb Armstrong, CS. You can join all of the education coaches there on X for our ongoing commentary. So, as we get back into this discussion again, my thanks to Mike Fairborn for helping to answer questions. My thanks to all of you for letting me take you on a little bit of a journey through index options in the context of a smaller trading account, and our great production staff for helping to bring this stuff to you today. We will see you guys again. Join me later this afternoon. I'm going to be hosting Liz Ann Saunders, our chief investment strategist here at Charles Schwab. We're going to be talking Liz Ann live this afternoon. We'll see you then. Take care, everybody. Bye-bye.